Okay everyone, welcome to a video. Haven't made a video in a while, so I thought I'd come on here and make a very short, brief video. Today's video is about currency trading, and I get a lot of emails and questions asking me about currency trading. So I'm going to keep this short and brief, but I just want to talk about a few topics in terms of what to look for when you're currency trading. Because I don't have the time to answer all the questions. So I thought I'd make this video. So we're primarily emerging market currency traders and commodity currency traders. So I'm going to talk about what we look at in the currency markets, some of the catalysts, and just briefly explain them, and sort of the difference between emerging versus developed currencies and why you should avoid the majors. So when we're actually currency trading, we're pretty much looking at only a few things in great detail. So we often start by looking at the capital flight accounts, and this is a sort of an overview of everything in terms of demand for a currency, supply and demand, and we pair this with portfolio inflows and outflows and foreign holdings. So because we're so active in emerging market currencies, we're looking at sentiment for currencies. We're gauging perceived sentiment by foreign investors, i.e. non-residents, just as much as the locals. And we're looking at these larger thematic themes to gauge basically interest in the marketplace. So we can see what is the interest for a certain currency. So when we track a lot of the central banks, whether they're selling or there's repo agreements, that'll give you a much clearer, more precise idea of what you need to be doing. And because we're tracking these agreements, we're looking at flows into state funds, sovereign wealth funds. These emerging market economies run on exporting some sort of commodity. So that's really important, and we incorporate credit. We look at the bond market, whether it's OFZs or anything like that. Because we're looking at a lot of the time the non-residents, we can use that to gauge more on the policy, central bank policy, and that will give us a much clearer picture. When you're looking at the corporate side, and we look at things like what we call corporate hoarding rates and burn rates for cash piles, this is another gauge for FX, volume, and you're looking at volume across the board. So when you're playing these thematic themes, one of the key themes that I often look at, and I use this as an overlay for my currency trading, is looking at the corporates on the corporate side. When you have corporates that are being pushed to accumulate large foreign asset holdings, foreign currency holdings, it's generally because there's a low local trust. So just because a corporate is stepping in on the bid to buy said currency, it's usually because they're trying to catch a leak, patch a leak, if you will. And that's often not a reason to become a buyer or bid that currency. So, when we look at currencies where the country or the economy in question is putting corporate capital to work, but they're increasing their local capex, it's very difficult to get behind a currency and to become a buyer. So that's more on the macro side and the fundamental side. When we're looking at some of the technicals, we do pay attention to things like looking at hedging, gearing ratios. We look at value at risk. We look at carry trade analysis. There's a lot of great carry trades at the minute going on. The Japanese yen is a particular interesting one. And we trade around volatility. And we're either building a headwind or a tailwind thematic based prediction, or a case study, as I like to call it. And when you're looking at things like the foreign debt relative to GDP, you can trade the spread. One of the things you can do is trade the spread between liquid currency savings and compare those to various sovereign funds, national wealth funds. A lot of these emerging economies, they are an exporter of a very specific type of commodity, whether it's crude, natural gas, the grains market, anything like this, palm oil. Whereas in the developed world, in the developed currencies, we don't really have a major export. These smaller emerging economies rely on exporting physical goods rather than the service industry or banking, if you will. So because of that, take, for example, Turkey. The Turkish lira is a trade we've been trading short for a number of years now. Turkey has approximately enough crude oil in its own country for 10% of the local resident demand. The other 90% of their crude oil demand comes from them having to import crude from the likes of the US, Saudi, etc. So as you can imagine, if the spot price of these commodities is going up, you're going to be in trouble. The likes of Turkey will suffer because that money, unless they're locking in forward accounts on contracts for crude, that money is coming out of the country's what we call the current account, and it's being depleted. As the current account value drops, investors become more wary and skeptical of investing a lot of the time. You'll notice a direct correlation between, as commodity prices go up, if you are a net importer of commodities, you import more than you export, your currency often suffers, and we can verify that by looking at current account values. So that's really important. We incorporate credit into some of our trades as well. Most of the active players, especially ones that are most volatile to rate swings, interest rate swings and things like this, looking at treasury yields, you can gauge market liquidity. It's a good indicator of liquidity. And that's why there's many opportunities in the commodity currency space. Always the big theme is the difference between commodity-rich nations and those that aren't. So when you look at the major pairs like cable, euro, dollar, they're often trending in a range-bound market. They're going sideways, so it's very difficult to make money. And one of the big misconceptions that retail traders have is that the markets are a $1 trillion business. In these major pairs. What they don't realise is that most of the volume that goes through, the tick volume, is simply corporates hedging cash accounts. And it's not speculative volume, so we can't jump on the back of that and make profits. So we like emerging economies, and we like to look at understanding the corporate side and the investor sentiment. And that's on the residents and the non-residents, the foreign investors side as well. And we look at current account sizes in sovereign wealth funds, national wealth funds. A lot of those oil profits, natural gas profits, they go into sovereign wealth funds. So these excess profits could get digested. When you've got periods where the commodity market is suppressed, it's not so much. So just wanted to make this very short video to talk about sort of currency trading, and that it's really not based on technical analysis. It's not based on understanding breakout methods and the usual stuff. So I hope this helps some people. This is a very short and brief video. There will be more to come.